Hi everyone, welcome back to my channel. So today's video is all about target date funds. So I'll start by explaining what they are and how important they function for long-term financial growth. So jumping right into it, y'all can see I have the BlackRock Index 2055 Life Path pulled up here under the Analyze tab. But as y'all can see, most of it is empty and the information is blacked out, so you see NA here. And the reason being is that these are not actual stocks, these are actually life cycle funds. Now, for anyone who may be unaware, a target date fund is a single all-in-one portfolio that automatically adjusts its collection of stocks, bonds, and even cash as it approaches a designated year. Hence why you'll always likely see a year in the title when you're looking at these dated funds, because they're simply structured for long-term goals, most commonly for retirement planning. So I know I haven't made a ton of videos talking about retirement, but I thought it was 100% necessary to discuss this topic in detail. So with that, TDFs are built for investors aiming at specific long-term milestones in life, and that's why these types of targeted funds can be extremely beneficial. Now, to explain this in a little more detail, we typically focus on ETFs, which of course are exchange-traded funds, but very rarely do I hear people talk about TDFs. But to be honest, this is really where the investing stability really is held, because TDFs reflect a certain timeline. So you may be wondering, why do they put a specific year in the title? And the reasoning behind that is that it's set so that as you're planning for retirement, this is going to be the targeted year that you choose. Now, of course, you adjust the year based upon your age and your approximate year of retirement. Now, the interesting thing about these funds are that they shift allocation. Now, TDFs begin with a growth-oriented structure. They're typically dominated by equities. Then gradually, for the most part, they transition toward a more protective collection built around bonds as the target year gets closer. Now, these types of funds automatically shift the blend of stocks, bonds, and cash as time passes. So it's basically following a preset glide path. And I briefly touched on that in a previous video, so I'll leave a link for it below. But I wanted to go into more detail in this video. Now, with TDFs, you can also be sure to note that they are managed. It's typically going to be a professional team that handles the allocation changes, so investors don't need to rebalance on their own as they age. And for the most part, you'll notice that target date funds, they commonly appear in 401k plans, and they're frequently selected as the default option in any type of workplace retirement account. So if you work a 9-to-5 and you do have a 401k, more than likely your place of employment is utilizing TDFs. Now again, early on, these funds lean toward growth with heavier stock exposure, and as the target year draws closer and closer, they gradually transition into a more protective stance by increasing allocations in the bond and cash market. And then some that you'll notice in this video, they're going to reach their more conservative mix right at the target year, while others continue easing risk levels well after retirement begins. And that's the main reason why it makes the most sense for setting up retirement, because they consolidate investing into a single low-maintenance choice. So with this example you see here on the screen with BlackRock, if someone were planning to retire in the year 2055, this may be one of the options that you explore in order to get more information on how your money can compound with this investment. Now, because you don't see a ton of numbers, here in Thinkorswim, they do provide at least a link that you can click on and it'll provide more information, detailing all the specifics of this fund. Now, real quick, I do want to explain the difference between a non-dated fund as well versus the traditional index or mutual funds. Like anything associated with the S&P 500 index funds or any type of general bond funds, they don't adjust based on future date, and instead they follow a stable investment approach. And because of that, they have a fixed structure. And basically what I'm saying is that their asset mix remains largely unchanged unless a fund manager intentionally updates the strategy, which is uncommon with index-based securities. And of course, it kind of goes without saying that the individual investor must handle their own rebalancing as their time horizon and risk tolerance evolves. And this just opens the door to have room for custom strategy, because these types of funds allow investors to construct portfolios that are tailored specifically to their goals rather than relying on a preset path. And it's often lower cost because many come with expense ratios that can be cheaper than some target date options. But that doesn't mean that TDFs aren't still a quality investment. So now let me go back to it and talk about some of the most popular target date funds and why they stand out for some of their strong returns and solid risk adjustment performance. Now the 5-year return on this index is at 12.2% with an expense ratio around 0.39%. So it's a little more passive of an index-based approach, which can help with consistency and cost. So this is one to look into for investors who want simple, low-fee exposure. Now switching it up, if we go ahead and take a look at Vanguard, we can look at VFIFX. And of course, Vanguard is going to be one of the most widely used and trusted TDF families in the US because many of these are going to be classified as a retirement series, much like the others. Now, the difference between other TDFs in the Vanguard series are that these accounts make up a huge share of assets, and they're also known for having low-cost index-based funds as well. The 5-year return is at about 11.6%, and it has a very low expense ratio at about 0.08%. And that's in the range for many of the Vanguard TDFs. Now, Vanguard in a lot of ways is also synonymous because their TDFs have massive assets under management, which speaks to trust and to scale. So again, this just kind of proves the reliability. So next up is going to be T. Rowe Price Retirement, TRRLX. And of course, this is actively managed as well. Now, T. Rowe's glide paths are a little more aggressive, and this also offers higher equity exposure, which in fact has helped in recent strong equity markets. So that's always a benefit. Now, their long-term track record for the last 10 years, it has had multiple advantages because it tends to outperform many of the passive peers, although fees are a bit higher, typically around the 0.59-0.6 range. But I will admit that with T. Rowe, many investors like their glide path and the management style, so that does provide a little bit of an upper hand with this one. Now next up is going to be JPMorgan, and we're going to take a look here. Now this of course is going to be a smart retirement blend, and it is going to be classified under R3. So this is going to be a TDF that's managed directly by JPMorgan's multi-asset team. You don't have to have a minimum investment with this one, and the expense ratio is at about 0.67%. It's also a pretty popular choice as well, especially among larger 401k sponsors. And essentially, it's pretty growth oriented for its allocation because this specific series is a blend of active management with competitive performance. Now, Fidelity also offers a few as well, as far as like the Freedom Index series, and they're very common in most workplaces as well. And they offer both active and index-based versions. Now, a question you may have is how do you choose given these parameters? Now, I always recommend when deciding which TDF is right for you, think through everything that you have as far as your risk structure plus your time horizon. If you're many years away from retirement, a more aggressive fund, of course, is going to have higher equity, so that may make more sense for you, but you have to be comfortable with the volatility that'll come with it. And then you also want to consider the fees. Even small differences in expense ratios can compound over decades. And even the glide path is something to pay attention to as well. So consider how aggressively the fund reduces its exposure to high risk as it approaches the target year. And that'll just provide the reputation and scale that you need as far as understanding the big picture. Because as mentioned, larger, more established TDF series, such as Vanguard, T. Rowe, and Fidelity, they tend to be more stable in terms of management and liquidity. And y'all know how much I stress the importance of that. But these also aren't the only options that you'll have. Nuveen also has targeted date funds that offer a broad suite of options. For example, TT, IPX. This is going to be the Lifecycle Index 2055 Premier. And of course, as others, Nuveen offers active mutual funds with lower cost and more stability because it's a bit more passive with the index mutual funds. Now, they also have what's known as CITs, which are basically just collective investment trust. And you can think of this like an institutional pathway often used in your 401k plan. It can be a little more complex, but I just want to provide that just basic understanding of it. Now, you'll notice with a great deal of the Nuveen TDFs, they include an annuity component to provide lifetime income in retirement. Because Nuveen, in a way, uses a through retirement glide path, and that means that the fund doesn't just become conservative by the target date, it again also continues adjusting even well into your retirement, which helps address the longevity risk since the design helps you manage over a longer horizon, not just the target date singularly. And for their income series, anytime you see those, that's part of the allocation that's directed to a deferred fixed annuity. And I'll make a separate video talking about TIAA, the secure income accounts. And that's good information that'll be needed as you move along the glide path. Now, one of the things that does separate the Nuveen target date funds are going to be the fees, because these funds are very competitively priced. But there is a fee cap in the perspective that reduces some of the cost. But on the other hand, they are a major player in defined contribution, which is of course DCs. And they do have one of the largest managers of DC assets. And in my opinion, their index series, it ranks favorably versus passive target date providers over at least the 3, 5, and 10-year windows, especially for like R6 shares, because it's delivered like solid multi-year performance when you take a look at the numbers. Now, they do also offer like income embedded TDFs, and one example is like their Lifecycle Income CIT series. It's designed to offer like guaranteed life income, but in my opinion, there's no guarantee of really anything as you near closer and closer to the target date. They're really just strategies for fully passive for the index, active, and a mix of it. But it really just gives you the advantage and growth during the working years and a payout structure after retirement, of course. So definitely pros and cons. And personally, I like to think of the Nuveen funds are very well diversified across several equities, and even in real estate in some cases. They even have a bit of cost flexibility because you're having both active and passive options. It gives you a trade-off between cost and potential growth. And then not to mention the fact that if you're looking for the income series, it is a very attractive offer, particularly if you're worried about longevity or if you want a more pension-like feature in your 401k. But that doesn't mean that risks aren't involved. While the annuity component is powerful, it does add structural complexity, because not all investors may fully understand or want to defer any type of annuity feature. So even in index TDFs, you're paying for the underlying funds too. The total expense is more than just the headline TDF fee, because some investors may assume that TDFs are like a set it and forget it, but depending on their actual retirement timeline or other savings, it may misalign with specific needs. So I always want to make sure that everyone is aware that for some mutual funds, after 30 years past the target date, the fund may be merged into another target date fund with the same allocation. So a quick recap on some of the ones I specifically like, one being BlackRock with their Index 2055 fund. Also have the LifePath fund of the Index 2050. Nuveen, as I just pulled up, with the 2055. They also have a 2050 option as well. But my personal favorite is actually going to be their R6 class, which of course is going to be TTIIX. And this one, of course, is multifaceted. Vanguard obviously offers some stable choices as well with their 2050 retirement fund. And they even have the option of their 2055 retirement fund, with countless others, of course. Now, the final thing to mention on this is that when you're looking at comparing, you can use Vanguard Target Retirement if you're all in on a classic, very low-cost mutual fund with long-term stability. But on the other hand, you can use BlackRock if you like a slightly more active glide path that uses ETFs and if you want very low-cost indexing. So it's all totally subjective on what you feel is best for your investment strategy and your long-term plans. So yeah, y'all, essentially that's all I wanted to discuss on TDFs for now. Of course, I'll make a part 2 going into more detail. And with that being said, that'll just about do it for this video. If you did find any of this information to be helpful, feel free to leave me a comment down below. As always, y'all already know what I'm about to say. Thank y'all so much for watching. And of course, I'll see y'all in my next one.